Welcome back, guys, to another roundtable. My name is Adam, Victor, Rusmin, Kenny with me, and you're the fifth person joining us. And today we're going to talk about China ETFs. I mean, there's a lot of things that's been happening in China. I think last week, if you check out our roundtable, there's been a tech crash, a lot of drama, and a lot of opportunities as well. But then in this roundtable, we're going to talk about how you can actually pick some China ETFs if you want exposure to the Chinese market, but you don't have to pick your own stocks. I mean, we've covered Alibaba and Tencent. Those are the big names, but there are other ways to invest, and that's through ETFs. So if you want a quick recap of what's happening in China, do check out our last roundtable on the China tech crash, and there's a lot of information over there. But right now, let's just talk about very quickly, just for those who just want a recap of something of why ETFs are, a good pick for some people versus, just picking stocks on your own.
Because you don't want to do your homework.
In a way, maybe, yeah. But so, I mean, why ETFs over stocks?
I think because stocks, generally, if you want to invest in Tencent or invest in Alibaba individually, right, there may be some risk because you may not know what you don't know, right? That's the thing, right? So you may concentrate, but in the end, it may turn out the other way, right? But if you invest in the ETF, you're investing in a basket of stocks, right? And Alibaba and Tencent is just one component inside. So even if they don't do well, the whole ETF won't tank, right? Or will be destroyed or something, or goes to zero.
So there's the diversification in a way.
Yeah.
Instead of just putting all your bets on one or two horses.
Yep.
You kind of just bet on the whole
you bet on the whole sector.
The whole sector, the whole market.
Yeah. And like aside from diversification risk, one thing is really good for people with not a lot of money to invest. So in the US, if you want to build a portfolio, you have to pay a $10 or $14 commission, but for some it's zero commissions. And it requires a lot to gain that kind of exposure. But then if you were to invest in the Hong Kong market, you need to buy 100 lots each, right? So you need to have
100 shares.
100 shares. Oh yeah,
100 lots is a lot. I know you got a lot of money, but 100 shares.
100 lots each. So then for Alibaba is about 3,000 Sing dollars, and for Tencent is about $8,000.
Yes.
So that's a lot for most people. And you don't want to concentrate all in one area. And for these ETFs, for example, the iShare MSCI China, the price is $72.22 US dollars in the US market. So with $72, you can gain exposure to around 50 to 800 stocks in the portfolio.
Well, that's for stocks and or ETFs listed in the US, so they go by singular units or stocks. But then for ETFs that are also listed in Hong Kong, which you're going to cover as well, they'll still go by lots, right?
Yes.
Yeah. All right. So, but that's a good point about if you don't have enough capital, if your portfolio is not so big, then one lot could be quite a bit of your portfolio. You don't want to concentrate so much of that into just China.
And of course, ETF is a good instrument for you to give you a immediate diversification. Right, it comes with a cost, right? So there's always an expense ratio that you need to look at, because when you invest in an ETF, there are certain ETF they will charge you about 0.5% a year to manage the money for you, right? So those are the expenses that you need to pay the ETF, although you don't really see it, but it will be automatically deducted on the fund itself. Okay, or else if you invest in the individual stocks, you don't have that kind of fee. So of course, both have their own pros and cons at the end of the day. Yeah.
All right. So there's some, I guess, ETFs play a role for certain investors. They don't want to do, just to summarize, some people don't want to do
limited time.
They don't want to do the homework on Tencent or Alibaba or JD or whatever it is. They just rather want exposure. They're just going to buy the ETF. And a lot of the reasons why you want the exposure and at the same time you want to diversify is because of the risk. Because you don't know what you're going to get. And like you say, you don't know what you don't know. So let's talk a bit about the risks that are in China right now. I mean, the last video, we covered a bit about it in the VIE structure and all that. But I think in this roundtable, we talk a bit more about the risk so people understand what they're getting into. So even though there's a crisis and there's an opportunity, there's also risk involved as always. And the thing about risk is you want to kind of like invest to the level that you're comfortable with. All right. So let's talk about some of the risks that could happen if you're going to invest in China right now.
I think the main reason now is, of course, the regulations. Last week, the video will cover a lot of all the regulation actually announced that are affecting companies like Meituan, Tencent, even Alibaba, and a few big internet companies in China. Okay, so antitrust issue is going to be it's ongoing, all right, and then of course they're also going to clamp down some of the data sensitive information. Like TT also got punished. So cybersecurity issues is something that they're also looking at. So they're looking for all these companies, and whether regulators look at them whether they actually infringe some of the data security issue, and if they did, they may be forced privatized or even get fined for doing that. Okay, and of course there are a lot of more things like there are threat from the US where they may force delist some of the Chinese ADR that are listed in the US, mainly because they have not complied with the audit. Or they are not able to comply with the audit. Okay, so now they still have 2 years to go, right? So some of these companies have to really submit the information to the US authority, but whether the Chinese government will step in and then stop them from giving this data to them, there's anyone guess, right? So those are the risks that I think may cause some of the ADR company to get delisted in the worst case situation. Okay, so those are risks that I think you need to be aware.
So I think one way to combat those risks is basically to invest in companies that are dually listed. And I think most of them are trying to list in Hong Kong right now, so they give you an option to move over. But at the same time, I don't think that the Chinese government will allow that. I mean, they are aware of this VIE structure that existed, and they allowed these companies to raise money, right? It's a big thing, and they couldn't be like, I'm not sure that this is happening, right? And then at the same time, once they yank it out, what happens is the global investors will lose trust in Chinese companies, and it will not be good for them in the long run, because it's always best to use outside other people's money to grow your business domestically, right? Rather than your basically your tech companies,
correct?
Rather than taking out your own money to grow your own business.
So I think now the ongoing the main risk is actually the regulation, right? I mean, you have seen how the regulator actually clamped down the edutech sector. So those are the one prime example where Chinese government will do whatever it takes to make sure that the Chinese are happy. So they will do it at the expense of some of those companies that they actually says that the education industry is actually hijacked by capital, right? So they kind of clamping down. They don't want their Chinese citizens to paying too much on all those tuition after school kind of.
So they'll basically step in for the social goods. So it's like, this is just getting way out of hand. I'm just going to step in. That's not going to happen in the US because there's lobbying involved. They're going to go through the courts and everything. But in China, it's just kind of different. The CCP calls the shots. And that's it. Right.
So anything could happen there. It depends on how CCP want to build the country. And in fact, just recently, I think last week we talked about Tencent the company, and just recently they on Chinese media actually announced that they're going to Chinese gaming industry is actually a spiritual opium.
So basically, people are addicted to the video games.
Sure, the share price tanked by 10%, right?
Yes, that's what I smoked when I was young.
I'm still smoking it, man. I'm still playing my video games.
Because that was the official media of the state.
Okay.
Right.
Yes.
But then I think it came out in the morning. But then I think in the afternoon the article was taken down. Because I think the state official says that it's not their view. It's not their standpoint.
It's not the official view. It's just like the opinion of the author there. Okay. But that's a really strong word because of the opium wars and the history of China and all that. To call an industry spiritual opium is kind of almost like I'm looking out for you, man.
Tencent dropped as much as 11%.
I mean, our WhatsApp groups were like, oh man, this is what's happening and all that. So it was pretty busy, but it was a big thing. So I mean,
so that's why ETF I think it gives you that kind of balance out, that kind of volatility that specific stock will suffer if let's say CCP decided to target that certain company.
So not all companies would be affected, but of course here right now we need to think that we don't need to be afraid to invest in the Chinese stocks. Not everyone will be affected. So what we need to do is to reduce our exposure or control our exposure to what's comfortable for us. That could be like 5% or 10% of our portfolio and no further, because not all companies will crash to like zero, right? Go to nothing for.
I mean, if the ETF goes to zero, means China goes to zero in a sense. Right? I don't think that's going to happen at all, right?
I don't think so.
So the ETF in a way kind of like covers all bases while giving you exposure, and of course, like you said, to a level of allocation that you're comfortable with. Some people are just more comfortable. They think that China's great. They can go much higher. But if not, just reduce it to what you're comfortable with. So I think we've covered some risks so far. So like the antitrust that's hit Alibaba,
cybersecurity,
Tencent, that cybersecurity was with TT and all that, right? The VIE structure. So that's if one way to and the delisting risk in the US exchanges, you can just go with the Hong Kong listed shares instead. So like Tencent, Alibaba, they're listed on the Hong Kong exchange. You'd rather go with that one, right?
Even for Alibaba, they are both dually listed in the US, also in the Hong Kong. So I'd rather go for the Hong Kong side.
Now, of course, if you have bought to the the US one, you can always convert it to the Hong Kong share.
Yeah, if you want to have a peace of mind.
Yeah, peace of mind.
Very important.
Yes, I mean, it's all about risk. I mean, it's all about probability and all that when it comes to investing. What do you think about COVID-19? It's still going on, the Delta variant. How do you think that will affect China?
There's also one risk that I think potentially, we don't know how China is going to cope with the new variant, Delta. And Sinovac, the vaccine so far, I think have no insufficient data, right, to prove that it's effective against the Delta variant. Okay, so we don't know how that is going to play out, but millions of people in China now actually got locked up.
Okay.
Because
lockdown, not
lockdown.
Lockdown is different. This is only different.
Going to prison.
So if that said, things get worse, of course, the China Tech ETF that we're going to cover today is going to be beneficial for them, because this is exactly what happened last year, right, during the COVID-19.
Actually, I'm not that worried because China is very good at controlling and people actually obey.
So there's a stat that I read that I think 95% of Chinese are satisfied with the CCP and what they're doing. That's very high approval rating.
This is a verified poll.
It's from a Harvard report. So it's a Western report, Harvard, that did the research, and the approval rating for the CCP in China is 95% as of that study. So I mean,
I think most people they understand the government, right? Your children is gaming a lot, cut down the time on the gaming, right? All this is for a better good for the society in the long future, but it hurts temporarily in the at the initial stage.
Okay. So I think just to sum up, these are the risks, and of course the big one is, of course, the CCP. You can't really predict what they're going to do, so you just have to weigh that probability of something like what happens to the education sector, which is a big one. So ETFs, I mean, quite a good option if you just want to have some exposure. So let's talk about ETFs right now. What are some of your favorite China ETFs? People who are watching this, if they want to have a look at ETFs, what would you show them, if you're going to look at ETFs?
So one of the biggest thing is one thing is where you like to focus on it, because you can focus overall on China or tech or certain sectors in China, basically. So the ones that I'll be covering right now is basically China overall, because once the Chinese government cracked down, actually overall the stocks or the Chinese market actually went down. So as you can see here, I have the iShares MSCI China ETF and the Spider S&P China ETF. So I'm going to compare three, and all of them are listed on in the US, because I mainly invest in the US, and people who are looking to gain exposure can go over there. So if you look at the iShares MSCI China ETF and Spider S&P China ETF, you can see that their holdings are pretty much similar to, and they are mostly filled with tech stocks that we are familiar with, like Alibaba and Tencent is a staple all across the different ETFs, and then you have Meituan, JD, NIO, Baidu, and the only difference is that they have other things like banks and insurance all inside, so then you get a minor diversification.
So basically they got a new economy, which is majority, and just a minority of the old economy.
So there's like the overall China ETF that you want exposure to just China.
Yes, that's right. And then most importantly, when you look at this, you need to see like the kind of weightage. So for some, they weighted heavily towards Alibaba and Tencent. For in this case, you can see that it's weighted like 13% for Alibaba and Tencent for MSCI China. And then for S&P China is about 12%. And then for China large cap, it's about 9%. So if you want more evenly distribution and not so much concentration on the top two, Alibaba and Tencent, then maybe you want to pick the iShares China large cap instead of MSCI China. Then at the same time, what you want to think about is these portfolios actually ranges from, like I mentioned earlier, from around 50 stocks to 800 stocks. So it depending, if you want more diversification, go for the ones with more stocks. Then last but not least, of course, I would like to touch on is the expense ratio. So expense ratio is basically the cost of diversification, right? On top of the commission you pay to enter, and every year you have to pay the cost of diversification of someone managing that portfolio for you.
Hidden fees.
Yes. Okay. So like on average, these hidden fees for this type of funds is around 0.63%. So that means for every $10,000, you have to pay $63 a year to be part of it. So for iShares MSCI China and Spider S&P 500 China ETFs, they cost about $59 per year. And then for iShares China large cap is $74, which is on the high range. So it depends on which one you favor and whether you're willing to pay more. Of course, ideally, I would prefer a lower expense ratio over the higher one.
So that's based on $10,000 investment. Here's how much you pay in fees.
Yes.
Yeah, not exactly hidden, right? It's pretty much like
it's obvious.
It's like a sticker fee. It's
you don't
right
really
there,
see
right?
it in your taken away.
It's just automatically taken away. Yeah, but that's the expense ratio that you have. So that's for overall China exposure. What about if you just want to focus on the tech sector, because that's what's happening right now?
Yes. So the whole tech sector actually is down. I think from the peak to the bottom, I think more than 40%. So this is a sector that I particularly be interested in because it's in the distressed sector. And a lot of them actually are Chinese tech. Okay, so there are two ETFs that I have here. One is the iShares Hansen Tech Etf, which is by BlackRock. Okay, so this is a pretty new ETF that it didn't come online, I think, in the September of 2020. And if you look at the top 10 holdings that they have companies like Meituan, Alibaba, Tencent, Sunny Optical, Xiaomi. So they have both the software and the hardware kind of tech scene in China. Most of them are pretty much listed in the Hong Kong Stock Exchange. Okay, so and this is quite a sizable ETF. I think they're about close to 9 billion in Hong Kong dollars in AUM. Okay, and their fees is only like about 0.25%.
So even cheaper.
Even cheaper as compared to what Kenny has brought up.
And most of the shares are not ADR.
I think I would say most of them are not ADR. They actually invest directly through the Hong Kong exchange itself. Okay, so this is for iShares Hansen Tech ETF, and the other one will be the Crane shares, which is primarily listed in New York Stock Exchange, but they also dually listed in Hong Kong. Okay, so this one, I think their size, perhaps the biggest one in terms of net asset, is about $4.7 billion US dollars. Okay, so it's probably the biggest China internet ETF. Okay, and if you look at the top holdings are very similar to the Hansen Tech ETF. Both these ETF have about 30 stocks in their portfolio, and most of them overlap with one another. Okay, so if you look at Crane share, they have Tencent, Alibaba, JD, Meituan, Pinduoduo, NetEase. This one is basically more focused on the software. The internet,
really
pure internet.
Okay, so and their concentration is also a lot higher in Tencent and Alibaba. Okay, so this one, of course, it comes with higher fees. You're looking at 0.73%, even higher than the one that Kenny actually brought it up. Okay, so given both, I know ETF are very similar in terms of exposure, I will actually look at iShares Hansen Tech ETF personally. Okay, if I were to choose an ETF to invest, primarily because the fees is actually very low, 0.25%,
and it's domiciled in Hong Kong.
Which is very important.
Because of the tax issues. I mean, if you're going to pick, number one is the delisting risk. If you're going to pick an ETF, you pick one that invests in the Hong Kong listed shares rather than the ADRs, right? The American Depository Receipt.
So that will remove your VIE, or rather the
delisting risk. And then the second one is, of course, the domicile. If it's in Hong Kong has no tax on dividends. But if you're going to go with an ETF that's domiciled in Ireland, there's a 15% tax. If you're a non-US resident, non-US resident. So, but if you're domiciled in the US, it's a 30% withholding tax. So, of course, if you're a US resident, it's totally different. But for foreigners, like we're based in Singapore, these kind of things matter. So, the Hong Kong domicile one is actually the most tax advantageous because of there's no tax on the dividends.
So, the Crane's shares that's listed in Hong Kong, the 3186, right? There is a domicile Hong Kong one.
So do check these things out. There's very different flavors for ETFs. There's like the overall China, if you want exposure to like the whole China economy, or you want to focus on tech. And then there's like the Hansen Tech ETF or the Crane shares China Internet ETF. A little bit different because like the Crane shares is a bit more internet, but higher expense ratio. But it's a bigger ETF as well.
But of course, you can expect more volatility on the tech. The tech one, right? As compared to what Kenny talked about, the whole China one, the volatility is much lesser.
So it really depends on what you are looking for, the individual investor. There's no one size fits all. What fits your portfolio, what your risk tolerance is.
What is you're more comfortable with.
What you're comfortable with. And of course, if you're not comfortable in China at all, then you just don't invest. Because it's really up to you.
If you don't trust the CCP, then
some people say I'm not going to invest in the CCP, and it's just their preference, and that's it.
So again, at the end, it's your decision, right?
So it's really up to you. But I think we just wanted to cover the risks a bit more in this roundtable because there are risks anytime when you invest, and what are the probability of these things happening? What you're comfortable with. And of course, if you're not looking at individual stocks, then ETFs are a great way to just kind of like get exposure in China overall and just the tech sector. So I hope this roundtable really helped you. I'll give you a bit more ideas as well. So once again, my name is Adam.
Of course, we also have Kenny.
Yeah, Kenny. So I just want to wrap things up. This is actually Kenny's last roundtable. So he's actually moving on to new ventures or adventures. Yes. And he's going to be a full-time investor. So we want to just let everyone know that he's not going to join us in the meantime, but he'll be back. So it's not exactly goodbye. He'll be back once in a while as a guest as well. Yeah. But I want to just give him a nice send-off and say, thank you for the last few years with this company.
All the best, Kenny.
Thank you guys.
So
thank you for having me.
Don't miss him too much. He'll be back once in a while. But all the best. All right, all the best. Yeah.
I mean, this guy.
Say that he did the wrong thing.
Another thing is, of course, with them is. Oh shit, I forgot.
Fine.
Huh?
The fine.
Yeah. So another thing is, of course, the compliance costs will actually go up.
So once again, my name is Adam, Victor,
thank you,
Rusmin, and of course Kenny.
Thank you.
Thank you so much for joining us for this roundtable. We really hope that you enjoyed this and learned something. If you like our content, please hit the like button. Let us know that we're doing something right. And of course, subscribe to our channel as well. Many more roundtables coming up. We want to make sure that the videos come to you as soon as possible. So once again, thank you so much, and we'll see you around again.